There you go. There we go. Perfect. That's better. All right, we're good. Awesome, sir. Good morning, everybody. Well, we'll give just a couple of minutes here to see if we got anybody else joining. I know there's another Zoom going on right now, so as people jump off that, we'll probably add some here, but we'll wait just a minute or two. And
I'm ready. I'm ready. Am I seeing this right? Are there two Dallases on
Dallas
this
is
Zoom?
Dallas is really excited about this meeting. I'll tell you that. He's so excited
That's
he's got it
awesome.
twice.
He's got a computer and a cell phone both logged in here today.
Yes, sir. Yes, sir. Yes, sir. All right. Well, hey, good morning. Good morning, everybody. Thank you for joining us for the annuity training today for our Tuesday training. Super excited. This morning we have Pat Schmidt. Pat's the executive director of advanced markets here at Impact Legacy Group. Super excited to see what Pat's got for us this morning. Pat's a great dude, got tons of experience, so I'm sure you're in for a treat. So Pat, I'll turn it over to you, sir.
Good morning, everybody. Good to be here today. Sorry, I'm in a space. I feel like I have a little bit of echo in here. Hopefully, the echo is not too bad on your all's end. But without further ado, I'll dive in. I want to make sure that I'm allotting time at the end here for questions. Let me share my screen as I run through today's topic here. So let me. Hopefully that's showing up on your all screen, but where I want to spend some time today with this group is really kind of stepping back and talking a little bit about the Impact Legacy retirement group, the retirement division that hopefully you've all heard now that we're continuing to build out the framework and the services and so forth, and not just that, but specifically being able to talk to the families that you are spending time with and the fears that they have and how we can come alongside you and equip you with the strategies and the tools and the resources to be able to make sure that we are eliminating those threats from retirement. So we'll capture those, but in essence, I want to make sure I just hit this again. We have a purpose when it comes to you all, and we exist to wanting to change lives. We want to impact the lives of the families you meet, but we most specifically want to impact the lives of you all and equip you with the tools and the resources, the relationships, the experience to allow you to serve your clients' financial needs and allow you then to earn more money and help build a legacy for you and for your business. And one of the big areas that we're going to be able to do that is to tackle this threat. And some of you have done some of the trainings that I've have led or heard David hit some of these, but the number one fear that retirees have is the fear of running out of money. True story, the Harvard Business Study did a survey, I think it's 3-4 years ago now, and they give all these retirees a list of all these various options in terms of fears. By and large, not even close to number one fear was the fear of running out of money. And I preface that by telling you that the fear of dying in retirement was actually one of the options on that list. And still people chose running out of money as a greater fear than actually their fear of health or fear of dying in retirement. So I'm sharing that with you because the folks that you are talking to, the families that you know, whether they're final expense clients, maybe they're Medicare clients, they may have these fears. And we want to arm you with some of the conversation starters and know where those fears are, what triggers those fears, so you can then be able to come alongside them and be able to help. And so here are those big fears. So not having a clear income plan, stock market downturn. So the market, certainly you're hearing this more than ever, at least for the first time in a 10-year time span, about how this can really trigger a number of fears. the tax man. You've heard us talk, and we're going to spend trainings in the future that are specific to taxes, specifically the taxes owed on these retirement accounts, and how Uncle Sam and the IRS wants nothing more than to get 30-40% of those dollars over the course of time. Where I'm going to spend a little bit of time today, though, is on high investment fees and costs, and how this can be a huge weight on people running out of money, and how you can have those conversations and be able to, replace some of those expensive investments for lower cost investments like the fixed index annuity, to be able to make sure that people can eliminate these high expensive fees and costs and be able to not run out of money. And then the number one reason people run out of money in retirement is not having a long-term healthcare plan. And we're going to talk about annuities and how insurance product can be a really good way to be able to solve that huge issue for retirees. So let's hit the investment fees and costs. And again, you might be sitting there like, well, I thought this was an annuity training. We're going to be arming you with these trainings to be able to help you sell annuities without selling annuities. So be able to have the conversations that people really need to hear, and be able to be a differentiator in the marketplace in terms of the conversations that you can have with the families, with the individuals that you're meeting, whether it's at your office or at their kitchen table. So let's talk about why investment costs add up and can be a significant impact to the people that you meet. And it's important to know that these fees and these costs, they really lie in two different areas. So that person that you're meeting with the first time, if they're using Edward Jones or Ameriprise, and the list can go on and on. If they are working with an advisor, they have two different costs. They have the cost that they pay their advisor, but then they also have the cost of investing and the costs that are associated with all of what they own. So the advisor, by and large, most advisors charge what's called a percentage-based fee, which means that they're charging a percent based off of the assets that they quote unquote manage. So if somebody has and let me step back, and most times that percent can be somewhere between 1% and 2%, sometimes more, sometimes less. Let's just use the 1%. So if somebody's charging a 1% fee, and let's just use for even numbers, on $1 million investment portfolio, that advisor is getting $10,000 per year on that $1 million, right? So they're getting charged that each and every year, regardless of how many times they meet with them, regardless of the services and the value that they bring, they're charging 1% on that total assets. Same goes for, somebody who has a $500,000 account, $500,000, and that same advisor could be charging that person 1%. Well, that means that 1% on $500,000. So they're charging $5,000 a year to that individual. Why I'm sharing this with you is that I believe that that's a very dated and broken system on how people charge. Very few industries, if any, work that way. I like to think, if I'll just use an oil change, for example. So let's say Matt and I drive a similar vehicle, right? But let's say mine's a couple years older than Matt's. Well, if let's say we're right in line to get our oil changed, and Matt goes in, or let's say I go first, right? I go in and I get the exact same type of oil, no tire rotation, just get the oil, and I drive away. Maybe it costs me $30. Now let's say Matt rolls in and he's got a newer car, takes better care of it. Let's say his car is worth twice as much, but he's gets the same type of oil, the same service. It takes the same time to be able to replace his oil. What if they charged Matt $60 to do the same oil change? But they did that because Matt had a car that was twice as valuable as me. Matt, would you be in an uproar?
Yes, sir. I believe so.
Right? Because you're getting the same oil, you're getting the same time, you're getting all the same things. Well, that's exactly what the financial industry has done. is they are just charging, the same person with a $500,000 portfolio twice as much as somebody who has $250,000. And at the end of the day, they're getting the same set of services, and it really doesn't make sense. And so many of you have heard how we are creating an RIA that has an investment platform to it. Number one, it's going to allow you access to bring over more assets to target larger accounts. But two, we are going to charge a different fee structure, a fee structure that's based off of services and value that we provide that ultimately results in thousands of dollars in savings annually, and maybe tens or if not hundreds of thousands of dollars of savings over the course of somebody's retirement. But that's just one type of fee, is the fee that somebody pays their advisor. Here's where the bodies are buried. So I'm going to peel back the financial curtain, is the internal investment cost. So that second type of investment that people pay. And no one knows what this looks like, at least the average investor, even the sophisticated investor, because these are the costs that are truly hard to find. Well, they give you a prospectus, right? And that prospectus can be, this is a notepad. It can be 3 times as thick as this, and no one reads that. They take it and they throw it in the recycling bin, or they throw it in the fireplace and burn it. But inside that prospectus has all the detailed costs. But even then, people can't articulate that. So what's in that perspective is all the different types of costs. Well, I'm going to tell you there's 2 types of investments that are the biggest culprits for these types of fees, for these highest fees, and it's mutual funds and variable annuities. And if you think about mutual funds, I'm not going to go into details of all these types, but you have sales charges and liquidation fees and QB1, which are marketing fees. So all the internal fees and costs. So I'll give you that example. Let's say somebody works with Edward Jones. Well, they could be paying 1 or 1.35% to the advisor for having their account managed at Edward Jones. But Edward Jones is just taking their money and they're putting them in various mutual funds or variable annuities. And all of those investments have an additional layer of cost to them. That mutual fund could be costing them another 1.5 or 2 or 2.5%. But no one sees it. Why? Because it just comes out of the investment performance, which means that it lowers the returns in the good years or amplifies the losses in the bad years. So somebody's paying 2% for a mutual fund and the investment performance was down 6%. They really may have lost 8% this year in that mutual fund. So those mutual funds can be incredibly expensive. I also want to give you a nugget here this morning. You may see a statement sometime that says, hey, this person has an A share mutual fund or a B share mutual fund or a C share mutual fund. And a lot of people think agents and those who own these investments, they think that A, B, or C has to do with a rating of the fund. That is not the case. That A, B, or C is all about when the commission is paid to the advisor who sold that fund. So an A share mutual fund is an upfront sales charge, which is called a front-loaded mutual fund. What I mean by that is if somebody brings $100,000 in and somebody sells them an A share mutual fund, that's a 5% commission. Guess what? Their original investment is no longer $100,000. Their original investment is now $95,000. It's not like the insurance company where that commission is coming from somewhere else. That commission is coming directly from that investment. That is very different. And those are things that are going to set you apart as you have start to give you a knowledge base to be able to navigate some of those conversations. But those mutual funds, just know that those can be another 1 to 2% every year. So if somebody's paying their advisor 1% and they have another 2% in internal costs, they're paying 3% a year for their investments, which means that they now have to make 3% in that year just to break even. And then another culprit, and I'm not a big fan of these, and you'll hear that more and more, is I don't love variable annuities. I love annuities. I love fixed and I love fixed index annuities. I think they're one of the best strategies and tools in the marketplace for retirees. I do not like variable annuities personally. Reason for that is this: the fees and the costs that are associated with them. The other reason I don't like them is because when you own a variable annuity, your money can go backwards. That variable has to do with the marketplace performance. And if you get a variable annuity statement and you look at it and you go to page 2 or 3 or 4, et cetera, it's going to look what feels like mutual funds. They're really what's called sub accounts, but those sub accounts can and will go backwards in times like we're having right now. But additionally, you got to pay the cost of those sub accounts. So you have those mutual fund accounts, but then you also have all the existing additional cost of ownership. I've seen variable annuities where I've run fee analysis for, where I've seen the internal cost of ownership be as much as 6% a year. I'm gonna say that again, 6% a year, which means again, that person has to have 6% performance to actually just break even in that year. So why I'm sharing this with you is that in those years, like 2010 to 2020, when the market is just skyrocketing, these fees and costs, no one cared as much. No one even really saw them as much, but they're starting to evaluate these things now. They're starting to see how these are amplifying the actual losses. So when somebody's market's down 15%, but they also have 4 or 5% fees, now all of a sudden they're closer to being 20% down for the year. They're starting to ask the question, what am I getting for this? This financial planner looked like a superstar during when the market was going like this, but what are they doing to provide safety? What are they doing when it comes to things like tax planning? Are they equipping me with a long-term care plan? Are they evaluating my healthcare and my Medicare strategy and insurance each and every year? They're not providing, nor do they have the tools and the resources, the personnel that you do to be able to come alongside them and help in such a comprehensive way. So we have talked through the Empower and Elevate case, but stepping back, the Empower case is when we're in the background and we're providing some consultative support, but you're running meetings. But when you elevate a case to our retirement team, we have a detailed fee analysis. So you get your hands on that Edward Jones statement or the AXA variable annuity statement. You send that to us. We have the resources, software to be able to do a detailed fee analysis where we can sit down with that person now and say, hey, listen, this is what you're paying right now. But by moving this to a fixed index annuity that doesn't have the management fees and costs associated with it, we use an investment platform that is significantly lower cost. What if we can save you $30,000 a year? All of a sudden now that's $300,000 over a decade. You start to really add those things up. You're providing a cure for how somebody's not going to run out of money in retirement by just restructuring their investment. And oh, by the way, by getting rid of that variable annuity and putting them in a fixed index annuity, they're now market protected. They now have complete downside risk, and they still get upside performance on how the market can do. So annuities become an incredible complement or credible replacement opportunity. I led last week's training. For those who were on last week, we talked about how those bonus products, we have fixed index annuities right now, you guys, that have double-digit bonuses. So if somebody's talking about, I've lost 10 or 15% in the market, we have some incredible stories to be able to tell with those variable, with some of these fixed index annuities that have 10 and 12 and 15% bonuses, some even more, that can all of a sudden win back those earnings just like that. Pretty cool story to be able to tell how we can get those people some earnings back right away. Last week, I also talked about how somebody might be in an annuity that may have a surrender schedule, and those bonuses can be a really cool way to be able to get somebody out of that and into a better strategy with better rates, more safety and security. But this detailed field analysis is something that we'll do. I mentioned this before, for those who end up using our retirement group and using the RA, which is that investment platform. All of the clients there will have a very understandable flat fee that's transparent and actually shows you what the services that we're going to be providing, and not just charging somebody based off of how much that they have with us. And then the last one that I will hit today, and again, so these are the big reasons people run out of money in retirement. The last one here is the long-term care plan, and the threat that this can have on somebody's retirement. So let's talk about the long-term care return concerns. And you're going to find a lot of people may not be familiar with what long-term care is. And maybe more importantly, are not familiar with the likelihood that they'll need it or what those costs look like. So some of the questions you can have with folks is, when you think of long-term care, what do you think of? And some people just think the nursing home, but it's not just the nursing home. It's home health care, it's assisted living, adult daycare, memory care, the whole spectrum of care that is out there. There's various surveys that come out each and every year that talk about the likelihood of Americans needing long-term care. Right now, for Americans age 65 and older, Americans 65 and older, there is a 70% chance that every American 65 and older will need some form of long-term care. 7 out of 10. Wild. Another fun fact for you, for a married couple 65 and older, there is a 90% chance that one of them will need long-term care. I was talking to some friends this morning. We're going to try to help out his aunt and uncle. His uncle has dementia. His aunt has been trying to be the caregiver and keep him at home and take care. We're going to be able to put some strategies and things in place that we can be able to protect and preserve money. So no, it's not too late, but the sooner that you plan, the better. Because, so again, the likelihood that you need stay is high. The average stay in a long-term care facility, 3 years. Guys, we don't make it near as long. Females are a little bit more than 4 years now. So the average stay is about 3 years in a long-term care facility. What would be important for you to know is just look at the monthly cost. I'm in Ohio. The average monthly cost in Ohio is almost $7,000 per month. But I'll tell you this, it's all based off the level of skilled care. So that assisted living may be closer to $5,000 or $6,000 a month, which brings down that average number. You need to know that there's people paying $12,000, $13,000, $14,000 per month for their long-term care needs. So how do we address these? How do we fix these? This is where you need to utilize your advanced markets team. We want to help you. Evaluating life insurance that has a long-term care strategy to it, or a hybrid policy. Companies like One America with their asset care products be able to do some really cool tax things to be able to take a traditional IRA account and be able to couple that with a long-term care benefit to it that can be utilized for husband or wife. So these are things that you have access to and that we can run illustrations and be able to support you. There is the traditional long-term care insurance that's still out there. We still have the ability to be able to come alongside you and run some various illustrations for this. I will tell you that it's a tough sell. I believe in having a plan for long-term care, but that traditional long-term care insurance is it a use it or lose it type of policy, meaning it's just like our traditional insurance, right? Our homeowners insurance, where it's nice to have in the event something happens. But if we happen to be the lucky 30% that don't need long-term care, all the monies that we put into that traditional long-term care over time, those dollars are lost. And oh, by the way, life insurance, know the likelihood that we'll need care and know what those care costs are. So you can imagine, if you've never looked at traditional long-term care insurance, for somebody who's mid-late 60s, it can be $3,000, $4,000, $5,000 per year for their annual premium. It can be really expensive. Still much better than paying out of pocket $7,000, $8,000, or $12,000 each and every month. But that's when people start to look at that hybrid life and long-term care strategy as being a plan. Fixed index annuities, gang, can also be a really good benefit here. There's some really good tools out there that we can add on in terms of additional riders on a fixed and a fixed index annuity that provide for home health care benefits, that provide for various long-term care benefits. So this can also be another great way to be able to solve this huge issue people have in using it through annuities. Obviously, life insurance and long-term care insurance, people have to qualify for from a health perspective. Annuities, there's no health or age qualifications per se. So this can be a really good tool that people can use to be able to have that cure, have that fix for the long-term care concern. And I'll share this with you too. I'm not an attorney. Got to give you the disclaimer there. But in my career, have worked with a multitude of estate planning and elder law attorneys. If you have an attorney and an estate planning or an elder care or elder law attorney that's in your region, I'd love to talk to them. I can maybe be able to have a conversation, you included, to be able to talk about some of the things that we can do. But they have what's called an asset protection trust or a Medicaid protection trust or Medicaid planning trust. Now, laws vary by state. A lot of states, Ohio included, have what's called a 5-year look back period. So what people will do is they'll put a house, they can put investments and insurance, annuities inside of an asset protection trust. If you're not familiar with what a trust is just a legal document that can own stuff. And by in essence, it's getting things outside of your name for 5 years. So if somebody created a trust today and they put a farm in the trust or their house in the trust, and they needed care, say 5 years or more down the road, the nursing home, the government can never make them sell that farm or that house and be utilized for those care costs. Attorneys who utilize these type of trusts want investments or want products in there that get tax preferential treatment. What I mean by that, they love strategies and tools that go tax-free and tax-deferred. I hope your antenna goes up, because what works well in these types of trusts, annuities work really well in this trust, life insurance can work really well in this trust. As somebody who has maybe a CD account that they want to put into a trust and make sure we get those dollars protected. And now we're getting a death benefit. And so there's a lot of estate planning pieces that we can be able to put in place in that part. And that can become a way to make sure that are qualifying people for things like veterans benefits and Medicaid benefits sooner rather than later. So all of those can be potential fixes that I want to make sure that we outline and share in there. So again, when you're talking and you've got people that are sharing the fear of, hey, can I retire? Or even if they are retired, but they're not sure they can successfully get to the finish line, that they're not sure that they can finish the race well, we can help. We want to make sure that we can solve these big issues. These are the 5 things. Having a clear income plan, it just creates confidence. Making sure that there's a plan for stock market downturns, making sure there's a plan for taxes, making sure that we eliminate those advisor fees and investment internal costs that can really add up over the course of somebody's retirement, and having a plan in place for long-term care. These are all things that we can come alongside you and help to execute and make sure that we have planning in place to make sure that your family can focus on the fun things in retirement and not have anxiety, be able to sleep at night, and be able to look at you as the trusted figure that can really make sure that it provided them this scope of services. So those are things I just want to make sure we spend some time on today. I'm going to do a little stop share with you and step back, breathe a little bit. I'm going to have a cup of coffee or have a sip of coffee. I love to hear some questions that relate to anything that we covered today, or if you want to take it a step further and talk about anything additional that relates to various annuities that might be out there. Do either one of the Dallases want to ask a question?
I have a question. What annuities are offering bonuses? I have one that does offer a bonus. I just sold one the other day. It had an 8% bonus. What other annuities are out there? It was an F&G plan.
Yeah, great question, Diana. So, and when you're looking at bonuses, I'm instead of just giving you the carriers, because there are carriers that do this a little bit different. So and we can be able to help, and we can even take this offline, but just for clarity purpose for everybody, there's what's called an income bonus, and then there's what's called a premium bonus. So sometimes you'll see like Allianz 222, for example, depending on the state, may have a bonus that could be like in the mid-20s. Sometimes they'll run specials that takes it up like in the 30%. That bonus is on a enhancement. It's on an income benefit base that can be utilized for a death benefit to pay out or various income strategies. But then there's a premium bonus. A premium bonus is added to the actual accumulation value or account value. I'll give an example right now. Security Benefit has the Strategic Growth Plus. It has a 12% bonus to it. So if somebody puts $100,000 into that today, they now have $112,000 accumulation value day one. And oh, by the way, if the market continues to tank, even that 12,000 they added by signing up is never lost. And a lot of your folks out there.
What was the name of it again? What was the name of it?
Security Benefit.
Okay. Okay, thank you.
My pleasure. And Diana, if you want to spend more time on that, Slack me and we can talk through specifics. A lot of carriers sometimes modify those bonuses by state. David, myself, Matt, we're actually working on trying to kind of narrow down that list of options. We have close to 60 carriers, and all those carriers have, sometimes dozens of various product off, being able to reduce that list down to help you be more efficient, be more focused on what strategies and tools can be great fits across the different types of cases that you come across.
Thank you very much.
My pleasure. Mike, no questions? I thought maybe you'd want like at least Ohio State score or anything like that.
Yeah,
what I thought was going to happen in the
I'll
Georgia
throw it
game.
out there. I'm married to a Georgia girl, so this is not going to go well for one of us, but one of us will be in the national championship game. So we talked about this last night. I do have a question. You mentioned earlier something about people that have surrender charges, where it drops every year down to maybe 10 years and it finally goes down to 1 or 0. Can somebody move from an annuity where they have a surrender charge, maybe they're in year 3, you can move them over to somewhere else where they're not going to lose any money because they're going from like product to like product, same company, or how does that work?
Yeah, thanks, Mike. Great question. So let me I'll answer that by using an example. So let's say somebody has an annuity that has a 6% penalty on it right now. Some advisors look, they're like, oh man, I can't touch it. You can absolutely put that person in a better position. So let's say, we'll use Security Benefit again. We'll make it sound like a Security Benefit commercial, but I'll just use that as an example here. And now you have, so let's say that person with a 6% penalty. So they're in a variable annuity that can be going backwards and can be losing money. Or even if they are in a fixed index annuity, but it has a cap of say like 3 or 4%, which is where some of those caps were just 36 months ago. You can now bring them to Security Benefit with a 12% bonus. So now they're still coming out ahead by 6%, basically. And the cap on that is close to 8%. So now you can be even doubling their cap and putting them in a much better situation. So I guess what I would tell Mike and others is if somebody says, I got an annuity that, I just got it a couple years ago, we want to absolutely evaluate that to see if we can put them in a better situation. Just given with, again, bonuses that are out there, cap rates that are out there, market security that's out there. There's a lot of things that we can still do and evaluate. I want to make sure I give a little disclaimer. Every company is different from a suitability perspective in terms of timing. Equitrust has a market power bonus that's a 10% premium bonus. But they won't, even if they can put somebody in a better situation in year 1 or year 2, they won't take it. It has to be in the 3rd year of that existing annuity before they'll evaluate replacement. So everyone may be a little bit different. We have all those guidelines, and we could ship it out and it'd be craziness. Just know that we have the resource and tools where we can provide some real quick answers and clarity for you on that. Mike, does that help?
Yeah, it does. Thanks. I appreciate that because everybody's different. And so therefore it doesn't hurt. What you're saying is it doesn't hurt to take a look at it, because worst case, they stay where they're at. They haven't lost anything. Best case is we put them in a better position. They're happy. We're happy. So thanks.
Absolutely. And I'll just kind of piggyback off that. Is you may look at that and say, oh, man, there's nothing I can do now, but now they're in your pipeline, right? And now you can continue to have the conversations with them. Maybe it's something that you can't replace for the next 6 months, but 6 months, you can kind of drip on them over time, and be able to come alongside them in that, when they get to a lower penalty period. So there's a lot of ways that we can go about and be able to help you navigate those conversations with those folks. Other questions? I'm just glad Mike didn't make me give like a prediction on Ohio State Georgia score. This is being recorded, so probably some last thing I need to. I went to the Ohio State University, and so I'm a hardcore Buckeye fan. But my spirits were broken a couple weeks ago. Good thing Chris Ball's not on here. He always gives it to me, being a Michigan guy.
Hey, Pat, there was a question that came into chat actually.
I missed that.
From Ann. She says, and I can read it to you. She says, annuities that have the owner choose how to turn it on, then gave the possibility of losing the amount if they choose the wrong option. Do we want to switch these?
Yeah. So if you're looking like if they turned on like the income benefit, I think is how I'm interpreting that question.
Oh, I do.
Yeah, absolutely. Listen, I would always lean on, hey, we want to evaluate this Mr. and Mrs. Prospect. We have a retirement team that's got various tools and resources that can be able to see if we can look at this and be able to put you in a better situation. My experience is you don't have to have the conversation there about a fixed index annuity as much as, hey, we got a team that has various tools and software that can evaluate, make sure it makes sense that we can try to put you in a better situation. And sometimes if they haven't, or sometimes if they've elected that income benefit, it can provide some handcuffs in terms of what we can or can't do. But certainly best for us to have a detailed look at it and see if there's some ways that we can be able to improve their plan, even if it's maybe just some underlying investments. Maybe we can't help them. One of the things that we want to be able to do is help every family we meet, and we hope that trickles down to you. And sometimes we may not be able to make them a client, but if they walk away from our conversation and helping their situation or give them clarity, that person can absolutely be an ambassador for you, for somebody else. Maybe it's their neighbor, maybe it's a former coworker, maybe it's somebody that's in their Wednesday night bowling league, about what you do and how you can help. And that person and that person and that person can ultimately become clients.
Absolutely. Good stuff. Guys, any other questions? Yeah.
Kind of a generic question, maybe I'm behind the times here, but if we have a case that we want looked at, do we just email you directly, or how do we run that up the chain?
I'll take this. I think I'll put it in the chat here, Larry. I will. There's a link, and if you'll fill this link out, it goes to myself, it goes to Pat, it goes to David, it goes to all of us. So I'm going to put a link here in the chat here in just a moment, and if you'll just save that, just click that link and fill it out. It'll go to all of us, and then we can get some eyes on it. So I'll put that link here in chat in just a moment. Jason Craig, were you about to ask a question, sir?
Yes, I was. Thank you. So
Yes,
good
sir.
morning, this is Jason Craig. You just mentioned covering long-term care needs with like a hybrid life insurance strategy. And I wonder if there are certain ones that are great for that.
Yeah, I mentioned One America and Asset Care. That can be a good one. To me, the next one that comes to mind is Lincoln Money Guard. They've been in the game for a really long time and got some really cool features and products that can be able to do. Their suitability is not incredibly overwhelming on the health side. So Those are the two top ones. For what it's worth, that was Jason, great question. A lot of the insurance companies have actually stepped out of the marketplace on the long-term care side. The reason for that is they were in it a decade ago and got burned because they didn't anticipate what those costs would look like in the long run. And so honestly, the number of carriers have changed dramatically. Genworth is still in that space though as well, but Lincoln MoneyGuard, Lincoln has planned properly for it, so they still have some really good features. And One America, that's been a phenomenal tool, and I've been able to help a number of families out on that piece too. And again, that's on the hybrid life and long-term care. And the reason people love that, Jason, is because it's not a use it or lose it. So that premium that they put in, whether it's a single premium or however they pay for it, creates a death benefit, and that death benefit can be paid for long-term care purposes. But if they are the lucky ones and go like we all want to go, which is peacefully in our sleep when we're old, then that benefit pays out tax-free as a death benefit to the family. So in a phenomenal way to create a legacy, and pass a legacy on to loved ones too.
Great question.
Absolutely. That answer your question there, Jason?
Yeah, thank you. I know I personally have often sold a Mutual of Omaha IUL for that, with that same idea in mind.
Yeah, that's another one that came to mind. Mutual of Omaha is planned for long-term care well too. So yeah, I'm glad you brought that one up, Jason. Mutual of Omaha is another good one.
Okay, awesome. Thank you.
Maybe just real quick, just to wrap up, I can share with you. I think maybe it was Larry asked that question in terms of that form that was in the link. Our goal was to try to make this incredibly easy for you. So if you go to what he sent you, you can put in the name of your prospect here. You can determine whether it's an Empower or Elevate. Elevate is where you bring in one of our experienced retirement advisors, and they run point on the case with you sitting alongside, so you get a chance to learn from the team. But you can put all things in here. What their retirement status is, where their money is, what are some of their retirement concerns. Maybe it's that not having a long-term care plan, but then there's also a place where they can upload statements here. So be able to put statements and so forth in here for our team to be able to evaluate.
Awesome. Perfect. Any last questions from anybody? If not, we'll shut this down. Anybody have any last questions? Pat, you did a great job this morning, sir. Excellent stuff.
Well, appreciate
Thanks,
everybody. Again, if we can ever be a resource, continue to reach out to our team. Use the Advanced Markets channel on Slack with questions. If you got a prospect that you want to introduce us to, or we can support and help behind the scene, use that link that was provided there. But we want to help you win, and we want to help your clients win. So thank you, everybody.
I have a quick one.
Everybody has
before we get off, if we can.
Yeah,
Sorry.
Go ahead,
no,
Tom.
you're good, buddy.
So if we Elevate versus Empower, are we splitting commissions differently somehow?
It is, and not to cut short, but if you go into that form and under the Empower and Impact, it'll show the difference of the structure on that in terms of like what that looks like.
Yeah.
And Tony,
The quickest
you can Slack
explanation-
me if you want to direct message me too. Happy to kind of walk you through that if you look at it and have additional questions. But I'll put that on my mind. That'd be probably good to revisit. I know we did that rollout, but it'd be good just for everybody to get some fresh eyes on that now.
Totally. All right. Everybody have a great day. Pat, thanks again, sir.
All right, take care, everybody. Have a Merry Christmas.
Merry Christmas. See ya.